How can someone use the standard deduction 1 year and then itemize charitable deductions using a donor advised fund other years? Maybe that refers to bundling.
So the concept of bunching, by the way, this is really a 2025 slide with the One Big Beautiful Bill, OBBA for short. This is changing in 2026, but I just want this as kind of a visualization of how this works. So the concept of bunching, you all probably know you have a standard deduction limitation that this year is $25,900. Essentially, 10K of that is charitable donation, 6K mortgage interest, 10K SALT deduction based on this example. Unless you exceed the standard deduction limitation, you're really not getting a charitable deduction in the current calendar year. So the idea is doing some forward giving in the current calendar year so that you can exceed the standard deduction limitation. And this is what that example would look like here. So if you did 3 years worth of forward giving, $30,000 instead of $10,000, you'd be over the standard deduction limitation by $20,100. So you'd be able to apply that $20,000 directly as a charitable contribution in the current calendar year, receive a tax deduction for it, and ultimately leading, based on all the scenario that we're using here, which is in that little fine print, I think the tax rate is like either 35 or 37%. I can't even read it.
35%. And this is something we've counseled clients on that are in their final year of work, where their income bracket's going to be the highest that it will probably ever be. So they're going to benefit the most from reducing income in the form of a charitable gift, to look at the next 3 years or 5 years. And if they have the assets to do so, to make a 3 to 5 years worth of charitable gift that year, where their income's the highest and they can benefit from the most tax savings. They then, over the next 3 to 5 years, can deplete the donor advised fund, all while still taking the standard deduction. It's an amazing strategy, which is why I think that was a great question to kind of tee up that concept. If you have a large income event, perhaps you get a large bonus, there's a business sale, there's a deferred comp payment, whatever that might be, think about what year a charitable contribution is going to be the most advantageous. And if that's a one-off event, in future years might normalize, or you might have lower brackets in future years, consider this bundling strategy and approach to maximize the tax reduction and the income tax reduction. So yeah, great question. Love this slide.